Right, I think we will get started only because it is a short, sharp 30 minutes on talking all things profit and loss and balance sheet. And for those who are going to be jumping on a bit later, they will receive the recording in any case. So we only like to make these webinars half an hour because, as you can imagine, people just sort of, glance over when it comes to bookkeeping. So I like to keep it short and sharp, only to because that's when most people just want to just take a few takeaways, and that is it. So how to read your profit and loss and balance sheet. Today's takeaways, I would love to see, especially our business owners, that we know Numeric Eight deliver the monthly reports, and I'm sure a lot of business owners get their monthly reports and have no idea what they're looking for. So I really just want to hone in on for you guys to understand what your P&L report is, understand what a balance sheet is, what the difference is. People do get confused on what are they looking for and what are the key things, and also using it as a tool. Like, how do you make decisions when you review them? But I think the key thing is understanding the difference, and also the items that you as a business owner should be looking out for. But let's just define these two reports. I've just put this out of Investopedia. So what is a profit and loss? The term profit and loss statement refers to a financial statement that summarizes the revenue, the costs and expenses incurred during a specific period, usually a quarter financial year. Let me just say that Numeric Eight like to do it on a monthly basis. These records provide information about a company's ability or inability to generate profit by increasing revenue, reducing costs, or both. These statements are often presented on a cash or accrual basis. So we'll go into that in more detail in a second, but I just wanted to give you the definition of what a profit and loss report is firstly. Let's just go into what a definition, just a short definition of a balance sheet, and that is a financial statement that provides a snapshot of what a company owns and owes, as well as the amount invested by shareholders. So I'm going to be sharing some examples of both of these reports, just so you know what you're looking at. Okay, let's just delve into what a profit and loss report looks like. Firstly, it shows your income, your cost of sales, and your operating expenses, and the net profit. What does all this mean? And let's just break it down a little bit. So firstly, I think it's important as a business owner that you look at this month to month. If you look at it month to month, it allows you to be proactive with what the business is generating or not generating. It also allows you to make some key decisions on what you may or may not want to do with the business. Now, with the sales, you'll see, sales is sales, but I also like to break up the sales. And what I mean by that is, what are the income lines for your business? So say, for instance, you have a product, like let's just say a training online as a product, and you might do face-to-face consulting. What you would do in sales then is you would break it up into two lines. You would have one specifically that the income you're generating on just your online training sessions, and then a separate line for consulting. That way you can see where your revenue is coming from. If you can imagine, if you just had it in one group, one income line and sales, what does it mean? It doesn't actually mean anything to you, except you know as a business what you've generated. Total income will tell you that. But look at your sales and look at breaking it down into product or your different lines of services, which will define and allow you to make some decisions. Now, cost of sales. I always say anything that is directly related to you generating that sale should go into cost of sales. I'll give you an example. If you have an income line as a consulting versus online consulting or training, your cost of sales would be, your face-to-face would be if you've got other consultants delivering, that would be a cost of sale. If it costs maintenance on your website, or you've got to employ someone to upgrade and update your online tool, that would be a cost of sale. So anything that's directly related to you getting that sale is a cost of sale. The other way to look at it also is when you're doing your pricing, for instance. When I'm talking about products, so if you sell products, when you're doing your pricing for a product, all those things that is part of your pricing should be in cost of sale. So if you're selling a product, if you're a distributor, for instance, and you're buying it from the manufacturer, that should be a cost of sale. Also, if, for instance, you're paying for freight on that product, freight should be part of your costing model. That would go into cost of sale. I hope I'm making that clear for everyone. And then that way you can see what your total income minus your cost of sales, you then see your gross profit. Your operating expenses are all things that are a cost to the business, no matter how much income you are bringing in. Your typical ones that you will see is rent, telephone, computer expenses, subscriptions, all things that it's still going to cost the business at the end of the day, no matter how much income you bring in. That should be under your operating expenses. And then, of course, out of all of that, you'll get your net profit. So it's really key to look at your profit and loss on a month-to-month basis, especially when you're looking at your gross profit. If you saw my last webinar, we went into margins. In a couple more webinars time, we'll be going into that in more detail again. But one area that you can assess on a month-to-month basis is your operating expenses. I'm going to say it's about 90% month on month. Your operating expenses are about the same. The only thing that will increase your operating expenses is if you've got employees and you're paying them on a weekly or a fortnightly basis, because your wages, in some cases, there might be 5 weeks in a month, or there might be 3 fortnights in a month. And of course, that will absolutely influence your net profit. Otherwise, your other expenses are pretty much the same month to month. Okay, so hopefully that helps you identify what a profit and loss report looks like. Let's go to the next slide, which actually is, what does a balance sheet look like? As you can see, both reports are really scaled down. It's only just to give you conceptually what it looks like. So our balance sheet, at any given time, you should be able to see the performance of the business as a company, what it owes and what it owns. So in this example, for instance, we've got current assets. Now, current assets would be all your bank accounts, firstly. You would normally have, it would also show, how much money's in the bank, cash on hand. It'll also show your, if you've got term deposits, whether you've got bonds, whether you've got, a tax provision account. So all the cash on hand, all your bank accounts should be in current assets. It'll also show your accounts receivable, how much people owe you at that particular time, given time. So if I was to put in a date, say the 15th of July, you should be able to type that in and it should be able to spit out exactly what your position is as at that day. The same with liabilities. So liabilities, it would actually have, if the company has credit cards, for instance, that should be reflected there. It also shows your accounts payable, which is what you owe your suppliers at that particular given time. Or your ATO liabilities like the GST, your employee taxes, that should be represented there as well. And then, of course, the equity is, your shareholders. The other key also area that I always like to look at is your retained earnings. Retained earnings is not only from the current year's profitability, but also from previous years. This is not such a good balance sheet, as you can see, because the total equity is at a minus just over $1,000. We don't want to see balance sheets in a negative state. This tells me it's not in a very good position. But of course, use it as a tool to understand what do you need to do to turn this around. So it might be that the accounts receivable needs to increase, which means it's telling me that the sales need to increase here. You've got too many outgoings versus your what's coming in. Just looking at your balance sheet. So it's really key that you look at both of these reports and you can identify with both of them. Okay, let's just go into, so what is the differences? And as you can see in the third column there, it's got a cash flow because people, every month when I'm explaining to business owners their profit and loss, and the most common question is, why don't I have any money in the bank account? Or, I'm doing really well because I've got all my money in my bank account. I can see how I'm going. So I've put a third column in there because between your profit and loss and your balance sheet, it shows you what your cash flow is. So let's just run through this, and I hope I can be as clear and hopefully in lay terms so you guys understand what I'm saying here. So profit and loss. It shows your current month and year to date results. Again, let's go with month. Let's be proactive and look at it monthly. It shows the revenue and your spending habits month by month and how quickly you can influence that. Spending habits, you can quickly, reduce a lot of your costs, or actually it allows you to even review your costs. One thing that one item I always ask is, IT subscriptions. How easy is it to put your credit card to an IT subscription and forget about it? So this tells you, wow, I'm spending too much money on subscriptions. Let's cut that. What the P&L is for the month, useful for budgeting and useful to set sales targets. So P&L tells you a lot. Now let's go to the balance sheet. It shows the company value, how much is in the bank, how much people owe the business, how much the business owes to suppliers. Shows the company liabilities, and also the retained earnings, as I said, your profit and loss from previous years. Again, between both of these, you can make a difference. And I'll go into that with the cash flow. So what I've just said, profit and loss plus balance sheet equals cash flow. So from the P&L, that is the net profit, then deduct items from the balance sheet that may need to be paid. Here's my example. On a profit and loss, we've got a net profit of $5,000. And this is where people go, why don't I have any money in the bank? When you look at the balance sheet, you're actually out of the cash. You've also got a car on finance, which is another $1,000 that is coming out of that, and a loan repayment of $500. Therefore, your cash flow in simple terms would tell me that there's only $3,500 left in the bank if all things were equal. Now, when I say all things were equal, is that the profit is determined also on making sure that you've collected all your monies, what you've invoiced, and what you've also paid out. Now, there's lots of terminology, lots of technical terminology we use, and one of them is cash versus accrual. And then again, people get confused with cash and cash flow. So when I say cash reporting on your profit and loss, literally it is the ins and out, basically from your bank statement. I don't really like working that way because it's not a true sense of how you're tracking. Because you might invoice a client, say in June, and that money comes in July. It really skews your profit and loss. What I do like to see is that on an accrued basis, that way your true expenses, your true revenue is reflected in that month. It then is up to you to collect that money to come in and out. That'll give you the correct net profit for the month. As my example here, with the net profit of 5,000 minus your balance sheet, I'm giving you what's left in the bank. I'm sure you're going to have lots of questions, so we'll leave them till the end. So let's go to the next slide. I've just done a couple more examples here just to help. I've just given you an example of a net profit of your 5,000 with your cash flow of 3.5. Now, if we use the balance sheet on top of your first example, I'm saying that a net profit is $25,000. The customers owe you $15,000, but you also owe suppliers $5,000, which means then your cash flow balance is $15,000. So you can then make some tweaks on making sure that your cash flow balance increases to as much as that $25,000 in net profit as possible. The key one is make sure your customers are paying within terms. You know, in an ideal, you'd have them all pay COD or 7 days. That's why online businesses are fantastic for cash flow, because people are paying for them straight off, like money's in the bank that day. And your suppliers, you pay them in terms. So let's just talk about an e-commerce business for a minute. So I'm saying all things equal, my e-commerce business saying we've got a net profit of $25,000. Because what has been invoiced is being collected, there's nothing owing by the customers. But the suppliers have given us 60-day terms or 30 days at month end, which means, can you see the difference? Cash flow balance is you're always going to be positive. Well, the only thing that influences that, when I say always, is when you're in growth phase and you're actually having to buy more stock. So that's a different issue. And that's just a cash flow management. And I have to say, cash flow, doesn't matter how small or big you are, it's always part of the business journey, always. Because I would normally see that most businesses are growing, so they're always going to have cash flow problems. But these are the things to keep an eye out on when you're looking at these reports, because you can make some really, really key decisions. Let's try and keep this simple. I don't like to try and overcomplicate it. Of course, you can always ask me questions after the webinar, and always happy to take it offline as well in unique situations, or if you actually want to talk about your situation in particular. So keeping it simple, a profit and loss report. Let's look at the total sales. Absolutely. Just keeping in mind, is it on a cash basis or an accruals basis? Remember, try and keep it on an accruals basis unless you're a retailer, for instance. Cost of sales margin and your gross profit margin to ensure that you're keeping your pricing model. As I mentioned, your cost of sales, everything in cost of sale is basically based on your pricing model. So for instance, if your revenue as a product, say it's $100, and your product costs you $50, you want to be maintain that gross profit margin, and that is key. Then reviewing it month to month at your operating expenses. Check out any anomalies or any costs that need reviewing. As you can see in this format I've just given you, and you can see very clearly what needs to be reviewed. And then based on your net profit, you probably know the items that you've got finance on. So, if you've got a profit of $5,000, you know that you've got, finance for equipment or a fit out or for cars or whatever it is, deduct that from that. So as I've just given you an example, if you've got a net loss on this example is $1,100, with an extra zero in there. Add car payment of $500, your cash flow is a negative $1,600. Hopefully that helps you with understanding a P&L and what the key things are to look at. So your total income, your gross profit, and your net profit. 3 numbers. Let's go to your balance sheet. Again, keeping this simple. Total current assets, noting the bank position. Hopefully, you've got 2 accounts. You've got your trading account and your tax provision account. So literally, if you've got your tax position account, where you've got current liabilities, which is owed to the ATO, it should offset each other. So if you're in your tax position account, you've got, say, $10,000 owing to the ATO, that should be already in your tax provision account. So then it's really just your trading account that you're looking at to see how much is in your bank account. The other one is key, is your accounts receivable. Look at how much people owe you. Try and reduce your receivables days, your turnaround days. I always say people hate people ringing for money. If you're consistent with it, people know that you're consistent with that, and so they just tend to pay. That's what we do. Especially when you're in manufacturing, we do scheduled weekly calls. Most suppliers or customers know that we're going to call them. So therefore, they'll pay within the right terms. One other thing is also, if you're the salesperson, you shouldn't be chasing your debtors. Salespeople and chasing debtors doesn't really go hand in hand. You'd want a good cop and a bad cop. So if you can, get someone else to chase your debtors and get them to do it routinely. Accounts payable is how much you owe to the suppliers. Don't pay them early, pay them on terms. You've been given credit terms. Pay them in the 30 days at end of month. Pay them in the 30 days. You're better off having the money in the bank. And then the other key number is your total net assets. That is the actual position of your business at the time. So if you click in today's date on your balance sheet, then you can see your position. So just with those numbers again, transaction bank account, make sure you've moved it into your tax account so you can see how much money you've got in the bank. Look at your accounts receivable, look at your accounts payable. What can you do about that to keep cash in the bank? I think that's about it to cover how to read those two reports. Has anybody got any questions for me? Or again, happy to take it offline. You know, under our professional, I suppose, what we do, everything's confidential. So if you wish to share something, happy to do it confidential and help you in making some decisions for your business on managing your P&L and your balance sheet and allowing you to make some decisions. Okay, let me just check these questions here, which I haven't answered. Should the payments needed from the balance sheet also show up on the P&L once paid? No. So, well, actually, that's a little bit about harder question to answer. It's not a, if you're reporting your P&L correctly, so let's just go with the theory that you're reporting on an accrued basis. An accrued basis means that the time that you've invoiced or the time that you've processed a supplier invoice, that will reflect on your P&L at the time. So when you make that payment, that will reduce the accounts payable on your balance sheet. Or otherwise, when the money comes in, it'll reduce your accounts receivable, and that money will be in the bank. So basic principles of accounting is double entry. So you can't have two entries go onto a P&L. It'll only show up once. So on an accrued basis, because I feel like I could be going into technical jargon here, so let me just repeat that. So if at the time of your invoice and the time that you process a supplier's invoice, it will go on the P&L. That will give you a true position of your net profit for the month. Once it's paid, it will reduce your liabilities if it's a supplier payment, or it'll reduce what customers owe you on the balance sheet. Now, the tricky thing is, if you are reporting on a cash basis, what I mean by that, if you're only recognizing your revenue and paying your suppliers from your bank statement, then that only shows on your P&L. Because theoretically then, you are not showing customers owe you or you owing suppliers on your balance sheet. Accounts receivable and accounts payable will be zero on your balance sheet because you're taking it at the time on a cash basis on your P&L. Can I say I thoroughly, I'm one to say, because you can't be proactive on your accounts when you're reporting on a cash basis. The only time that you would be a cash basis business is if you're a retailer. Not even then, on a retailer, you would still have your inventory and you would still have your supplier payments on your balance sheet. It's more around a transactional business that you would be on a cash basis. But if you're, your timings will be out if you're not careful. and then it throws your P&L. The amount of times that people show me a P&L and you got the highs and lows and you weren't expecting it, it's because of the way you're reporting on that. Hopefully that answers that question. The difference between a budget and a forecast. Okay. A budget is something that we normally set in May and June based on the last 12 months of historical numbers. You can basically make a call on what that might look like for the next year. We normally would implement your budgets for the next 12 months in your system. Sometimes you review your budgets on a 6-monthly basis. So you would do it, just before 1st of July, and then you would do it in December for the next 6 months. That's a budget. Once it's set, it's done. A forecast is that when you're looking at your month-to-month reports, you should be able to forecast your pipeline. And then you can actually make some calls on what your P&L might do based on your forecasts. Forecasting is pretty much, and the big 2 ticket items on here are revenue and people. So by doing those, if you can forecast your revenue out and then forecast when you need to put people on, that is a really great tool. Hopefully those answers that question. Again, please feel free to reach out. I need to wrap up. We're just gone over time. So hopefully you've got lots out of it. And I'm going to be on again next month. We're going to do these 30-minute sharp little webinars just to help you understand your finance area of your business. And the next one is how to use the profit and loss as a sales tool. Really an important one for all those business owners that need to understand when they've got salespeople or even themselves, how they're going to understand what their budget is and what their forecasting is. That was a great question before. So I look forward to seeing you on the 23rd of August from 11:30. See you guys.